I recently covered the shipping industry, specifically ZIM Integrated Shipping Services, based on their solid performance over the last year, massive growth, bargain bin metrics, and a record $17 dividend. Despite all these factors, the stock has fallen over 37% from its $88 high. With all the volatility in the market right now, it's no surprise that some companies are being thrown out with the bathwater. So I'm going to explain what's going on here, what I'm doing, and I'm going to be introducing a new stock that I've added to my portfolio. Here we go. If you haven't seen my deep dive on ZIM Shipping, then check out the link below, as there's a lot of good information there about why it's such a good company. The issue remains though that despite hitting a $91 high and growing 48.54% since our IPO last January, the stock seems to have taken a dive. What you have to realize is that when a company is offering a $17 dividend, there is going to be a call out to the dividend whores, the investors who love to jump on a company for the high dividend, then sell immediately afterwards. This is usually a poor strategy, as the stock often drops so fast afterwards that the drop can offset the value of the dividend and the whole transaction becomes moot.
It's like a cow's opinion. It just doesn't matter. It's moo.
When it comes to ZIM, once the stock went ex-dividend on the 23rd of March, it dropped like an anchor, right at the worst possible time. With current world events, investors are looking for any excuse to liquidate, and that drop gave them just that. If you were following the comments, then you might have noticed me talk about this issue with some subscribers, and as much as I hate the way this happens, I knew it was a risk, and I did cut my position before it tanked. So now, here we are. A good company that was on a rocket to the moon that seems to have blown up in the atmosphere, falling foul of investors. So it's currently trading at a discount, or is this a massive correction of an industry? Well, let's break it down. The fundamentals of the shipping industry haven't changed by much. Too many goods are manufactured abroad, and ZIM have secured some key routes around the world to bring those products to us. Having gone over the latest earnings report, ZIM continues the trend of exceptional performance, hitting a new revenue high of $3.5 billion. As part of their massive 2021 expansions, they have grown their container fleet by 20% and their carrier volume by 23%, and are boasting a fleet size of 1 million TEUs. What has me excited about this company is how rapidly they are expanding their fleet. They acquired another 8 second-hand vessels in September and October, which is a great short-term solution in expanding their company book assets. What really stands out for me is that in last February they had already started expanding their LNG fueled vessels, with long-term charter agreements with Seaspan for 10 7,000 TEU vessels to be delivered over the 12 months starting February 2023. These contracts will run for 12 years and include an option to add another 3 years and priority should they wish to buy them at the end. In July they expanded on this deal with an option for 5 additional vessels to be delivered during the first half of 2024. Then in September expanded this even further to include another 5 vessels. With oil at an all-time high due to recent world events and the world looking to LNG as an alternative to oil and gas from Russia, it's incredible foresight for them to be building their fleet this way. On top of solid financials and performance to date, this is setting up a massive catalyst for the stock to rally again, and ZIM becomes a market dominating force in shipping over our toasters and iPhones. If you had owned the stock from the start and never sold, then you might be a little pissed off with your recent losses, but with the market being what it is right now, everyone is feeling some pain. Looking at the stock at $55, it trades at 1.43 times past earnings, 0.62 times sales, and 1.45 times book value. Ignoring their special dividend and assuming they continue their previous $2.5 dividend, that's a yield of 4.5%, which is great news to investors who love a dividend. Gangnam Style. At these levels, ZIM has gone into stupidly undervalued territory, and I think we've seen it go as low as it's going to go. With the stock climbing 5% over the last 5 days, I think we've seen the bottom of the teacup and this stock is going to bounce back. Market consensus remains high for the company, and although they rate it as a hold, the average target price is hitting $82.60, representing a 48% upside. That's more than enough padding to take a large position right now, so I've been reinforcing my position over the last week. However, with the market being what it is right now, I'm not throwing everything back into ZIM. If you've been watching the comments on that deep dive, then you might have noticed that Bob Johnson asked me to look into 3 dry bulk carriers. I've been doing just that, and out of the 3, there's one that I think offers a good investment and a means to diversify my investment in the shipping industry. So here's a breakdown. So Bob asked me to look at Star Bulk Carriers, Golden Ocean Group and Eagle Bulk Shipping. Out of the 3, I think Star Bulk provide the best investment. Here's why. Star Bulk Carriers are one of the largest dry bulk shipping companies listed on the Nasdaq, operating with a fleet size of 128 bulk carriers, and they claim to be the most cost-efficient dry bulk carriers in the world, with a focus on sustainable and environmentally friendly operations, avoiding oil spills and reducing emissions whenever possible. Star Bulk specialise in shipping iron ore, coal, grains and other minor dry bulks in specialist container freight ships. These types of commodities have developed a reputation of being cyclical, but if we look at their individual markets, it's a bit more complex. Iron and steel prices have been rising and falling sharply due to how China has been trying to monopolise the market, producing more than they need so they can dump cheap steel on the market, undercutting competitors around the world and costing many steel workers their jobs. The EU and US have implemented tariffs to try and protect their steel industries, where even the slightest change in prices can have a ripple effect on the many industries that need steel for manufacturing. But implementing tariffs for political reasons contrasts with the World Trade Organization's policies, so it's quite complicated. Coal is viewed as a dirty fuel in the modern Western world, being the single largest source of global carbon emissions, but it remains the largest source of electricity production and a requirement of steel and cement production, and not helped by the rising cost of oil and gas prices. According to the International Energy Agency, world consumption continues to rise, and their Global Energy Review for 2021 reported a 6% rise in demand and expect a record high in demand for 2022. As for grains, as populations continue to increase, world demand continues to increase, and according to the Agricultural and Horticultural Development Board, they are expecting a massive growth in grain and oat demands, driving up prices even further. And don't underestimate minor bulks, namely steel, forest products, bauxite and petcoke, which is for aluminium production, fertilizers, cement, scrap metal, sugar, salt. These have worldwide appeal and demand continues to rise. To put it bluntly, freight companies transport these commodities halfway around the world to meet demands, and they can adjust their fees to reflect changes in cost, supply shortages, and growing demand for these products. Dry bulk carriers can diversify their loads to focus on another commodity or control the flow of supply. Star Bulk in particular use moderate and adaptive strategies with their fleet, using different transport times to suit the demands of the market. Depending on what each vessel is transporting, they can place them on a longer route or have them closer to ports to deliver items when the market demands are the highest, in effect avoiding an oversupply at ports and keeping demand high enough to justify their fees. They are in the continual process of expanding their fleet through acquisitions, and since 2017 the company has almost doubled their fleet size from 70 ships to 128. Star Bulk are an active leader in setting standards in the industry and have been recognised as a B- rating by the Carbon Disclosure Project in 2021, the highest score for any US dry bulk company. Part of this achievement is how Star Bulk are focused on operating as efficiently as possible, and to achieve this they have focused their fleet expansion towards larger and thereby more efficient vessels. 94% of their fleet are fitted with scrubbers, exhaust gas cleaning systems used to remove harmful emissions from engine exhaust gases and help the engines run more efficiently. It's a similar concept to the EGR systems introduced to modern diesel engines to meet EU emission standards, but instead of AdBlue, they use seawater. Star Bulk claim that these systems have saved them $210 million to date. Star Bulk also plan to fit 97% of their fleet with ballast water treatment systems, which effectively filters out the water the ship travels through to remove organisms and prevent them from being transported to different environments where they could cause harm to the ecosystem. These strategies are important because, according to Clarkson Research, there has been a general decline in orders of dry bulk ships since 2008, largely due to many of these ships not living up to the evolving environmental standards or providing fuel efficiency adequate to keep up with rising costs and EU standards. These ships have even resorted to slowing down in order to improve fuel efficiency, which has created greater demand due to the increased transport times. These increasingly difficult conditions mean fleet growth is expected to decline sharply in 2023, shrinking the market even further and creating a massive advantage for the few operators who meet the necessary standards. I think ZBLK have set themselves up to take advantage of a world that is struggling to source the very commodities that they transport, and we could be seeing this stock explode over the next couple of years. But as always, here's where the financials do the talking. To value ZBLK, we have to take a slightly different approach to container carriers as the TEU scale doesn't apply. Instead, we need to use two different methods of measurement. The first is deadweight tonnage, which is essentially the volume of goods by weight for each vessel. By this measurement, company performance grew by 3.8% in 2021 and has been averaging 2.2% growth over the last 5 years, with the expectation to continue this across 2022 as the demand for their commodities is expected to grow by an average 3.7% compound annual growth. These may not seem like massive growth figures, but this is where the other measurement comes in, and that's the time chart equivalent, which measures the daily revenue performance of each vessel. ZBLK report this figure along with the daily operating expenses and net cash losses for each vessel, which is used to calculate the earnings per share. We can subtract expenses from the TCE value to give the overall net income for each vessel. From this measurement, ZBLK comes second to global leasing, but in terms of growth over the last 2 years, they have far surpassed the competition, with an average growth rate of 42.4% each quarter. These results show a massive growth in 2021, hitting almost 1.5 billion revenue in 2021 and $500 million in the last quarter alone. So this company continues to grow at an amazing rate. A pandemic stock, this is not. The company is growing cash and they have put this to good use expanding their fleet without having to take on excessive debt. This is reflected in shareholder equity growing at a consistent rate, with earnings per share having a massive jump in 2021 alone. So the financials show why ZBLK claimed to be one of the most cost effective in the business. The stock continues its momentum, now trading at $28, which is just 4.19 price to earnings and 4.83 forward price to earnings, 2 times sales and 1.39 book value. This adds up to the highest metrics of the three, but when reviewing the margins, the company offers the most value with 47.67% profit margin, a 30.36% stock price upside from analyst sentiment, and their latest $2 dividend represents a yield of 28.47%, of which we'll likely see another paid in May, which is fantastic news for investors who love a dividend.
Mitt Romney style. Romney style. Mitt Romney style. Romney style. Mitt Romney style.
Nobody likes to see their investments take a dive, especially when they're good companies with solid financials and great growth. Unfortunately, external events are a factor we can't always anticipate, and investors must either have the discipline to take profits off the table when the moment arises, or the resilience to wait out a beating, or the funds available to take advantage of a short-term dip. The shipping industry continues to hold relevance in the short and long term, and where ZIM and ZBLK are using aggressive growth strategies, it seems to be paying off now and setting them up for greater gains in the near future. In a volatile market, these are the opportunities we should be looking for, more than just big tech companies who have long peaked. I've been buying into ZBLK over the last 3 weeks and I'm already up over 7%, and I think we're going to be seeing further opportunities on the way. I think the stock is a winner and we're likely to see some massive growth in the industry over the next 2 years. So that's my take, and as you can see, I do follow up on your comments. So if you have anything you want to say, comment below, let me know. And if you like what you see and you want to see more, remember to smash that like button and hit the subscribe button so you don't miss out on future videos. Until next time.